Charlie, you're muted.
welcome to the
Off to a
Bitcoin Stock
Fabulous
Show.
start on this rendition of the Bitcoin Stock Show. Charlie, how we doing today, man?
Oh, I'm fantastic. It's been a huge day of content across the whole block space media landscape, but we're talking Bitcoin stocks now. Now, Colin, I'm woefully undereducated on how equities work. I've been studying Bitcoin for the past decade. I don't know how these equities trade, but apparently now we have to pay attention to them. It's like, you're our guy. You're our man who spends all day looking through K2s or Q10s or whatever they're even called. So, yeah.
Isn't that funny? The guy who studied Faulkner in school is now looking at line items and juggling spreadsheets. But yes, does anyone really know how these equity markets work, Charlie? I don't think so. I think that generally speaking, the meta has been number go up and Bitcoin mining stocks go up accordingly because they are high beta plays to Bitcoin. That being said, the market is starting to mature. There are certain miners that are separating themselves from others in terms of their operating prowess and their ability to execute on promises. We've said this before in this show. It used to be that a giant public miner could announce a huge ASIC order and that would bump its stock price by however many absurd percentage points over the course of the day. That doesn't necessarily work as much anymore with Bitcoin mining outright, but it does kind of work with AI strategies, which we'll touch on later in this stream. And we've touched on it in a bunch of other shows too. It's the biggest investment thesis for public miners and really the broader market in general. How shall we say, it's the market's investment thesis du jour. But all that being said, we published a newsletter and article today on Q2 numbers for public miners, and you look
And
like
we'll get into that, but for the people watching, we do encourage you to write in, give your comments both insightful and perhaps even a little bit trolling. The place to do that is on YouTube because you can comment on YouTube or LinkedIn, which we're streaming to as well. I don't know if you can say anything on X. I don't know if we have that chat enabled yet, but yeah, YouTube and LinkedIn, you can chime in and we may throw a couple comments on the screen. But yeah, as you said, Colin, we've the past 48 hours have been kind of a back to back, like A and B newsletter. Most of the work from you and a friend of Blockspace, Brandon Bailey, Beezy with Second Gate Advisory. Which one do you want to kick off with first?
let's go into the Q2 update, and then we can zoom in on BitDeer and talk about Beezy's research note that he recently published for Second Gate. Really good research note. And before we hop into that, it was an opinion article by Bitcoin Beezy, and it does not reflect the position of the Blockspace staff or team. We don't pick winners here. We just look at the numbers. So to dive right into it, most of the major public miners have filed their second quarter financials. Typically, these financials are filed with the SEC around about a month and a half, or around about a month from the time that Q2 or a quarter closes. So a lot of these were filed in the first 2 weeks of August. We've churned through the data and we've picked out kind of 7 charts that we think represent where the public miners are, specifically after the halving. So let's maybe back up a second and talk about that. Obviously, Bitcoin miners have been talking about it for a while. You can go ahead and reshare the screen, actually, Charlie, because
Gotcha.
I'm going to start scrolling. But so the Bitcoin having happened in 2024, it was Bitcoin's fourth halving. It dropped the block subsidy from 6.25 to 3.125, and all else being equal, as I write in this article, that should have a direct impact on mining revenue to the tune of about 50%. You're basically taking a 50% haircut on how many Bitcoin are produced per day. Bitcoin's price has actually gone down since the halving. So in some ways, the haircut has actually been worse on a dollar denominated basis. And also something that I wouldn't say has been under discussed, but is perhaps underappreciated by those who aren't as tuned in as the head of Ord over here at Blockspace. But Ordinal's trading volume, inscription trading volume is way, 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 way down. Charlie had a great thread on this the other day. Everyone who bought node monks are now poor. They're living in a van down by the river or in a cardboard box under
If
the
we only even
grass.
had a van, we've sold the van, we've leveraged it. That got the bank, or rather the loaning apparatus we loaned it against, also took that. Like, we have absolutely nothing left except for our JPEGs.
And yeah, so in 2023, the ordinals and inscriptions craze took off. Casey Rodamore Casey Rodamore and Raf Jaff basically publicized the standard really kind of in the beginning of 2023, but they had created it at the end of 2022. And no one saw it coming. It was a dark horse for Bitcoin mining revenue in a very, and I say dark horse in a good way, because a lot of miners were getting crushed, hash prices at all-time lows. And then all of a sudden you have this new standard for creating NFTs on Bitcoin that ended up sending fees to the stratosphere. They hit multi-year highs, pissed a lot of people off for understandable reasons, but also made miners very happy. And one of the things that really sent fees into the stratosphere was this token standard called BRC20. We won't get into the technicals here. I recommend going to Blockspace, reading anything by Charlie on the subject. He's covered all of this in great detail and in very clear terms. But basically, BRC20s were a very inefficient way of creating non-fungible tokens fungible tokens on Bitcoin. And this was replaced largely in the market by Casey Rodamore's Rune standard, which launched during the halving. And Runes worked in a way. Transaction fees have been lower as a result, because Runes are a more data efficient way of creating these fungible tokens. And all of this to say, because I'm kind of digressing, but hash price is all the worse, not just for the halving, but it's also much lower than it might be otherwise if ordinals, inscriptions, and fungible token trading on Bitcoin from all of these new standards were at levels that we saw last year. So just to give an idea, yeah, thanks for pulling that up, Charlie. There's hash price index from our friends at Luxor Technologies. Go check out Hash Rate Index, great resource for Bitcoin mining data. But as Charlie can kind of show you there, you can see hash price over the last year has peaked at about $172 per petahash per day. That was a direct result of the Runes launch. Upon the halving, there was this kind of land rush to mint tickers under the Runes standard, but that's very quickly petered out, and it was not too shortly after that hash price hit an all-time low of $45 per petahash per day, only to hit another all-time low once again in August of $35 per petahash per day after Bitcoin took a dive to $55 or $50,000. All of that to say, if we look at hash price over Q2, it dropped 27% from its average in Q1. Its average in Q1 was $92 per petahash per day, dropped to $67 per petahash per day. And if we look at the actual quarter to quarter change just from spot, it's even worse. It dropped 57%. So all of that to say, we would expect the public miners to take a hit on their revenues from this, and that's exactly what happened. So Charlie, if you'll go ahead and swap back to, thank you very much. Every single miner in our update saw their revenue decrease from Q1 to Q2. Some did better than others at stanching the, hemorrhaging of cash flows that the halving precipitated, but across the board, they all ended up bringing in less revenue last quarter than they did in Q1. Totally expected. This is not a surprise. Anyone who knew anything about the halving knew that this was going to happen. And I think you also saw in the, I would say, traditional equities landscape of, sorry, let me back up. Sounding like Peter Thiel on Joe Rogan's podcast. You're seeing more and more from traditional investors that they are factoring these things in. And I don't have this chart in front of me. I'm going to probably pull it up at the end of the show. So please remind me, Charlie. I need to go in another report to get it because I created it for Luxor. But basically, every single miner without an AI strategy is down year to date. And the reason for that, even though Bitcoin is up, is the fact that I think investors are finally pricing in things like the halving. Whereas maybe last cycle, there were only like three major, I think it was Riot, Mara, Hut 8, Bitfarms, and maybe Hive. So maybe like three to five miners were around during the last halving. These were not things that the investors were savvy to. The market was much less sophisticated. Now we're starting to see this actually matter for public miners. And it's also why you're seeing public miners start to try to diversify their revenue streams, right? Spoiler alert, it's a lot easier said than done. And as I wrote in a Forbes column a few months ago, a lot of this diversification in revenue typically has come from, wait for it, more mining. You build out a 100 megawatt data center, you could only afford 50 megawatts worth of capex of self-mining. So you end up renting out that rack space to other miners through a hosting program. Most of public mining revenue usually consists, and still does, of either self-mining or hosted mining. And then if you're BitDeer, you have a cloud mining segment in there, which is where you're renting out hash rate to people at really exorbitant prices. It's not really a good thing to do. I mean, if you're BitDeer, it's a great thing to do. You shouldn't buy a cloud mining contract. You're going to get raked over the coals. Or if you're Hut 8, you have managed services, right? So when Hut 8 merged with USBTC, USBTC purchased a lot of contracts from other miners during Compute North's bankruptcy. And now Hut 8 manages those contracts. They don't own the hash rate, but they take a management fee for basically looking after the machine, staying on site, making sure everything's running properly. So those of, self-mining, managed services / cloud mining, and hosted mining are typically the ways that these public miners have drawn revenue. The ways in which they've diversified recently, as we've seen in headlines, or they've tried to break into AI and HPC. A few notes on some of the miners here. Hut 8 has one of the older HPC segments of any of these public miners. They purchased TerraGo in 2022, I believe. Could be wrong about that. It was a data center company in Canada. And that is a traditional data center that Hut 8 just straight up bought outright, right? They're not building it themselves. They're not trying to retrofit a mine. And that's very important because as we're going to start seeing, I think over the next year, AI strategies and HPC strategies between miners vary drastically. A lot of miners are saying they're going to retrofit, they're going to put GPUs in their data centers. That's going to be difficult, I think, to remain competitive versus a miner who is kind of either just going to build one from scratch, go buy one. As we've seen recently, Core Scientific leased a tier 3 data center in Austin. Now they're going to try to retrofit or build their own to supply CoreWeave with capacity for CoreWeave's HPC fleet. All that being said, there are a bunch of different ways to skin the AI cat, and currently it is not making up very much revenue for these miners. I mean, as you can see from this chart right here, the HPC segment for Core Scientific and Hut 8 are the largest of any miners, and there's still a very tiny sliver of their overall revenue. So the takeaway here for this is there's been a lot of effort for miners to diversify. We're not really going to see the fruits of this diversification probably for at least a year, maybe even more. Because, in Core Scientific's case, if you can go and look at their schedules for building out these data centers for CoreWeave for the AI compute, we're talking multiple year projects, right? These take a long time to stand up. They're a lot more complex. They cost a lot more money than a Bitcoin mine. Any thoughts there? Any questions, Charlie? I'm kind of just ranting. So
no, I really like this. I mean, the TLDR is like it's wild that the only miners who they performed at all well were the mullet miners, as Tom Masiero would say, the AI strategy. But I mean, it makes sense. Like the stock price of these should probably go down if the real profitability goes down. To me, this is the market getting a little more sophisticated. So let's go to the power pipeline, baby.
So this is show me the money, baby.
Show me the megawatts. Show me the money.
This is, according to some, they might argue the most important chart if these miners can execute, right? And this is part of Beezy's bull thesis, Brandon Bailey's bull thesis on BitDeer, which we'll get to in a minute. But what do you do if you're a Bitcoin miner and your revenue is halved and the entire network is trying to expand because their revenue is also halved and they're buying new machines and they're plugging in the latest generation ASICs? Well, you do the same thing and you want to expand your hash rate. And the only way to do that, obviously, is to either take up current megawatt capacity that is not being used or expand. And every single Bitcoin miner in our update is seeking to rapidly expand their megawatt capacities through 2025. There is a typo on this chart. I hate it. It says Q2 2024. This should say Q2 2025. We're going to go in and amend that after the live stream. But all that being said, as you can see from this chart, we can look at current megawatt capacities, which, most no miner
get it over our heads.
Sorry?
Scroll down just a little bit so we can get it all.
So no miner is currently at a gigawatt. But at the end of 2025, we will conceivably have at least 3, maybe 4 if Core Scientific gets a little crazier and adds 70 megawatts onto its current pipeline. We're going to have 3 miners with a gigawatt capacity if they can execute on time. Now, that's a big if. I'm always hesitant to put charts up like this, and the same reason why I'm hesitant to put up expected hash rate, because we have seen time and time again public miners say that they're going to be at X hash rate or X megawatt capacity before or after a certain checkpoint, and then they just never get to it. So I think it's important to take this chart with a grain of salt, but I do think it underpins the point that over the next year, these miners are going to try to expand as aggressively as possible. And the most important thing with that expansion, as we will get to in the next chart, is are they actually going to be able to turn a profit on those megawatts, and how are they going to fund it? A lot of these miners have funded portions of their additional capacity that they're building out currently. Some, they're still looking for ways to do it. One of the ways that they have done this is through at the market offerings and equity offerings that dilute shareholders. But what are you going to do? Your stock price increases 200% year over year, and you're not going to cash in on that. I get why investors don't like it, but to me, it's it's an easy choice if you're one of these miners. So going back to that point about revenue per megawatt, this is perhaps one of the more important charts, and it's going to be especially important as we look into AI strategies. So this shows how many dollars a public Bitcoin miner brought in, not from their hash rate, but specifically from the megawatts that they have under management. Because again, it's not just pure play mining, right? Like BitDeer's hosted segment is larger than their self mining operation. I think core size, it's used to be larger, but now it's about on par. And so what this chart basically shows you is how efficient are these miners at turning dollars or turning megawatts into revenue. And some surprising finds if we break it down on this level, right? For instance, Hive is in the lead here. And Hive is, if we scroll back to this one, it's the runt of the litter. It's at the tail end of this chart in terms of total megawatts under management. And so some people might say, well, Hive needs to continue expanding. It's not doing enough to stay abreast of the rest of the market. And I'm sure Hive shareholders would like to see more hash rate deployed. But on a per megawatt basis, they're making more money than any of their competitors that we analyzed in this chart or in this report. So that's important to note. CleanSpark is second. Perhaps we're not totally surprised then that CleanSpark has been on perhaps the most historic run of any of these miners. You know, they started blowing up last year. The stock price surged, and they kind of came out of nowhere to become one of the top 4 miners in
I mean,
the
yeah,
industry.
pure play miner, massive expansion, went from, I forget, bottom half of the pack to consistently the leader in just exahash deployed. Pretty wild story. And I don't think they show any signs of slowing down either, which is
No, that's the crazy thing. And CleanSpark to me is such a good example of finding your edge as a miner. You know, this could be anything from like we were talking about in our spaces today. If you're a residential miner trying to find ways to arbitrage your solar panel array or, you know, certain power spikes or, you know, power shortfalls in your area. For public miners, obviously they all have their own gimmicks, but CleanSpark has basically become one of the leading public miners just from mergers and acquisitions. They have been dogged about finding opportunities with basically turnkey Bitcoin mining sites. And I mean, basically all of their hash rate and megawatt expansion over the last 2 years has been from mergers or has been really from acquisitions. And they've really found a way to aggressively expand what you doing that, right? If you can find a distressed mining site, you can basically buy hash rate at a discount to what you could, you know, purchase it on the spot market and then build out the capacity yourself. So this is a great chart. I think it says a lot, and it doesn't tell the full story though, because when you see Hive in the front and then you see Riot in the back, you then have to look into why that's happening. Part of the reason why Riot is in the back here is because they sacrifice uptime for curtailment credits. So it may not be totally fair to just evaluate Riot based on how many dollars they're producing per megawatt, because they can lower their all-in power costs dramatically. They have one of the lowest costs of any miner, which we'll see at the bottom here. After you factor in those power credits, they're paying like $27 a megawatt hour for direct power costs, which is absurdly low, especially when you consider that some of their peers are paying $40 to $50 a megawatt hour.
yeah, it's like that's why we got to look at multiple dimensions because you might almost not even call them Riot like a Bitcoin miner. They're more of just a power trader.
Mm-hmm.
I mean, that's a highly differentiated company. It's a very interesting strategy because they're just by raw megawatts deployed and future expansion number 1 or 2, I think. And so it's like really interesting to see them leverage that particular skill set. Yeah, I'll let you keep
Right.
going here.
Right, and to your point, you know, as our friend Beezy says, these are infrastructure companies, and you kind of have to treat them as that, and that's what the market is really starting to treat them as. I mean, you're really less of a Bitcoin miner and more of a load center, right? You have hundreds of megawatts under management. How are you going to use those megawatts? And there are multiple ways that you can deploy them, as we've seen, either through demand response to the grid, self mining, hosted mining, or the Golden Goose AI if it works. More on that later. I sound like Donald Trump. I don't know if it'll work. So
but yeah, we'll come back. We'll at the end of this, we'll ask, is AI a meme? Also, if you're watching this, do you think AI is a meme? Let us know on the YouTube stream, and we'll highlight your comment.
maybe we should do a poll under this live stream tweet too.
Yeah, that'll be good.
So this is looking at our next chart. This is a pretty simple one. It's basically looking at a public miner's reported power costs and reported fleet efficiency. Caveat with this, I did not back out these numbers myself. You can actually look at a public miner's Bitcoin production and look at hash price for the quarter and a few other variables, and you can, within a certain degree of certainty, back out their effective power cost, or as I call implied power cost for that quarter. That's probably a better way to do it. I'm also inclined to think that these miners are not going to lie about what their power cost is on these SEC filings and in their presentations. That being said, there are accounting games that they can play, but these should be more or less accurate based on what I've seen when I backed out the costs themselves for prior reports. But in addition to that, we also look at their self-reported joule per terahash. Now, I'm less worried about them cooking the books on that because that's actually, if that's a little easier to audit. And if they were lying about that, there would be a bunch of analysts jumping in their asses. But this tells a pretty simple story, right? Going back to Riot, they have one of the lowest power costs of the bunch. Actually, they have, right next to Cypher, they're both at about $27 per megawatt hour. And Riot's also been very, very proactive about improving their efficiency. They just stood up Corsicana. They have the first phase of that facility energized, and they are outfitting it with the latest generation machines. And I believe the first phase, I could be wrong about this, is all immersion. And it is WhatsMiner M56 and WhatsMiner M56, 56 and 66 series immersion models. So they've really beefed up their efficiency. And as you can see right here, they have one of the lower ones in the bunch. And then you have miners like Hut 8 and BitDeer, which have kind of fallen behind in terms of really improving their efficiencies. I think that we can point to Bitfarms here as a miner that has done a very good job. Bitfarms' efficiency last year was in the ballpark of like 40 joules per terahash, and they busted ass and they've gotten it down. I think it's about 25 joules per terahash. This is a bubble chart, so I'm sorry, it's not precise, but like the actual figures that go into the Excel sheet are a little bit abstracted by the fact that these bubbles are huge. But y'all get the idea. And one last kind of thing to comment here on BitDeer, and we'll get in this in a second. Part of why they probably haven't upgraded their fleet is they're trying to produce their own ASICs right now, their own ASIC miners. So why would you go to Bitmain and MicroBT and purchase a bunch of next generation machines for a premium when you are conceivably going to be able to purchase that hash rate at a discount from your own manufacturing capacity? So that'll be something to keep our eyes on as we round out the year to see if BitDeer can really deliver on its ASIC miner manufacturing promises.
Yeah, and if you consider what we talked about this morning on the block spaces, if you can cut the margin you would lose by having to buy your rigs from a third party manufacturer, your hash cost numbers do look a little bit different, and that might come into play when they start deploying these seal miners. So that's pretty interesting. And also, you mentioned Bitfarms. Notable in Bitfarms news today is the Stronghold acquisition, I believe.
I missed that. Did Bitfarms
Yeah, dude.
acquire
So this was only
Stronghold?
a few hours ago. Yeah. I feel like I don't want to blindside you with it because you've had your nose buried in the books all day.
Wow,
But they
that's big.
just announced that Bitfarms is acquiring Stronghold. So or Stronghold.
That's an interesting move. So Stronghold operates its own coal refuse power plant in Pennsylvania. It's a power plant that runs on waste coal. So people might not know this, but there are certain grades of coal that when they bring it out of the ground, it is of a certain it's basically of a content that they can't refine it for certain power plants. But there are other ones where they'll take it there and they can burn it, and that's what Stronghold, they run a power plant in Pennsylvania that basically uses this waste coal for the backbone of its power production. And Stronghold's really taken a back seat to a lot of the public miners. They have not expanded really at all over the last few years. They used to be more in the conversation, but they're kind of, to your point earlier about miners being more energy plays. Like Stronghold has always been a textbook example of this. And this is an interesting play by Bitfarms. I want to read more into it before I say something stupid. But it comes at an interesting time too, because it almost seems to be, and I think that I think there's been rumors about this for a while, but it's coming at a very interesting time considering the takeover attempt by Riot.
Riot was getting close to the poison
Riot
pill event.
Riot was getting close to the jugular. So for those who don't know, Riot Platforms was basically instigating I guess they call it a hostile takeover, I don't know, of Bitfarms, where they were purchasing Bitfarms shares to basically have enough of a weight to where they could just subsume the company entirely and make, basically have enough voting share to make decisions for the company. And I don't know enough about that stuff, so I'm talking completely out of my ass, but it almost seems like maybe this helps insulate Bitfarms a little bit. Maybe it doesn't. But if their stock price surges from this, it's going to be harder for Riot to continue to purchase shares to get that position so that they can have power to make decisions that otherwise Bitfarms wouldn't want to make. Again, caveat, I don't know anything about all of this corporate governance stuff. Someone could correct me in the comments, please do. But the timing on this is just fascinating.
I mean, look at this. Look at this. This is today. So we're seeing stock price up. I don't know. It's up a little bit.
Yeah,
today.
not too terribly much. And I don't own any Bitfarms. Bitfarms doesn't sponsor the show, but so this is just from the heart. Bitfarms is one of the most criminally undervalued miners, I think, out there. They have one of the lowest SG&As and payrolls of any of the miners. They have a pretty diversified portfolio across South America,
Canada, South America,
Canada,
hydro. Like the hydro
US.
play is just the play. It's just the play. It's always been the play, and I think it's just going to be a play going forwards, and they know that. They've been and we like Ben Gagnon. We like to see the Ben rise.
Yeah, Ben is an OG and a Bitcoiner at heart. And so anyway, I just feel like there's been this eternal September where Bitfarms is always trading between $2 and $3 per share. I just, every time I look at the stock, like no matter what happens, Bitcoin could be up 200. I mean, it's just crazy. So maybe $2 to $4. But anyway, really cool news. We'll probably dissect that a little bit more on the Mining Pod Roundup, either this week or next. But if we could just go back to this, wrap this up, and go to Bitfarms or BitDeer, excuse me. This, in addition to dollar per megawatt hour, is one of the most important charts. And this is the one that will scare you the most if you're balls deep in mining equities. Because shy of a Bitcoin bull run, all of these motherfuckers are mining at a loss. Every single one except for BitDeer. Whoa, hang on. Is it BitDeer or Clean Spark?
Yeah, BitDeer. Yeah, we may have to take a second look at that. But basically, the short version is, it's like, look, the main story is what shows is that everybody is in the red right now as we speak.
Yeah, and to explain this, and the reason I just got confused, this is why the editor needs an editor. I misspoke or miswrote in this article. It's not Clean Spark it's not Clean Spark, but it's BitDeer is the only miner that is currently has a positive hash cost. And what I mean by that is their hash cost is lower than hash price. So to back this up a little bit, hash cost is basically is a counter point to, or is a counter metric to hash price. So hash price measures how much money a miner can earn per day per hash rate, either in dollars or BTC. Hash cost is the inverse of that. It's how much they're spending to produce that hash rate. So if your hash price is at $50 per petahash per day and your hash cost is $40 per petahash per day, you're making $10 per unit of hash rate that you produce, per petahash that you produce. And so as we can see from this, and as I write in here, only one miner was above, or all of these miners except for Hut 8 had a lower hash cost than the average hash price for Q2. But given current hash price of like $43, there's only one, and that's BitDeer, which currently has a positive spread when you factor in their hash cost and looking at the hash price. So, this really doesn't inspire confidence. A few things are going to happen for this to change. Bitcoin price rips and hash price rips, and miners are okay again because they're more or less in the green.
And it's happened many times before. Miners
has
hang
happened
on,
many times before.
white knuckling it.
Yeah. I mean, this is really how 2020 kind of panned out, right?
Yeah.
I mean, hash price hit an all-time low in Q4 of 2020, and then Bitcoin ripped. If you believe the 4-year cycle thesis, there's nothing to worry about. If you think that maybe macroeconomics matters a little bit more with regards to Bitcoin price, then you might be a little bit worried given recession fears in the US. But that's kind of for another discussion, I think, another day. But a few the other things that miners can do to improve this is they can upgrade their fleets, which a lot of them have been doing, and there's room for them to do it a little bit more. A lot of these hash costs will improve over the next year because miners have not received all of their shipment of next gen machines. But there's only so much further they can go down that joule per terahash curve over the next year. The other thing that they can do is they can lower their selling, general, and administrative and payroll cost. And this includes that, by the way. Sometimes we've seen hash costs where it's just direct mining costs, and it paints a much rosier picture. If you were just doing power costs, all of these miners basically would still be in the green. But once you factor in administrative costs for C-suite and payroll, and also factor in financing costs, which this includes as well, shout out to the Miner Mag, great data. A lot of these miners are in trouble, and by a lot of them, I mean basically every single one of them. So, really need hash price to get back above 50 for half of these guys to be doing well in that department.
I need hash price to go up. Can devs do something?
Yeah, I mean, you're the ordinal guy, man. You need to get these degens.
Bro,
to start
I'm
trading.
trying as hard as I can. I'm now pushing on a string. I don't know, like the people. I'm trying all I can. So.
The unholy alliance of ordinal NFT crypto degens and Bitcoin miners. They're both gamblers at heart. It makes sense.
Both, yeah. The thing is, like, it's socially acceptable to gamble on equities, and it's not socially acceptable to gamble on JPEGs. That's my soapbox. I'll put it over here for now. Shout out all you mining mafia listeners. I mean, it's a socially acceptable gambling. So
penny stocks are okay.
Yeah.
Monkey JPEGs are not. Remember?
No, definitely not okay.
So last chart for today, and there's not too much to say about this. I think it's just always important to look at balance sheets. Most public miners have very minimal debt, and the ones that do have debt typically have the cash and Bitcoin position to easily cover it. Look at CleanSpark. Their total debt is minimal, and they have a bunch of cash and a bunch of Bitcoin to extinguish it. Same with Cypher. Hive is in a similar position. Bitfarms has been building debt recently, but they still have plenty of cash and Bitcoin to cover it. Mara is in the same boat. Riot is just insane. They don't have any debt, which is wild, honestly. And the only ones that have more debt than their current cash position are Hut 8, BitDeer, TeraWolf, and Core, which still has mountains of debt after restructuring in Chapter 11. It emerged last year, but maybe AI can save Core. Who knows? Their share price certainly has surged as a result of all the AI hype, and that gives them a lot of room to maneuver into a better cash position with things like ATM offerings and stuff like that. That being said, a lot of their cash from anything like that and their cash flow is going to be reinvested into infrastructure because they're going to need a lot of capital to pull off this AI transition.
I look at this and there's a couple takeaways. One, I mean, Core made it through the first round, the first gauntlet, and really was kind of the success story this past year. But I mean, look at that. Look at the amount of debt they have. That's still, they have a long ways to go yet. But then the other takeaway is that I hadn't realized just how much Bitcoin these folks had on their balance sheet in comparison to like the rest of the cash they've got. This is pretty wild, and I don't know. I make this point all the time. Like, I don't think you'd see this in other types of commodities production businesses. Like, they don't, like, you don't have these people holding on to these deep like exposure to the actual spot ownership
Yeah.
of those things. And then take a look at I would say the two most OG like frontmen and guys spearheading these two companies would be from BitDeer with Jihan and Bitfarms with Ben. Two of the most OG people, and they have, among the companies who have the most Bitcoin on the balance sheet, the lowest ratio of Bitcoin on the balance sheet. So this is an interesting observation where you have like the people who have been most bullish on Bitcoin seem to be running operations which have comparatively lower Bitcoin positions in comparison to their cash positions. Mainly, yeah. So
Yeah, that's a good point. And when I used to work with this guy named Yaron Mellerud. I don't know if you were at Luxor when Yaron was there.
yeah,
Very
love
brief.
Yaron, great
Yeah,
Swedish or Norwegian guy.
great Norwegian,
Norwegian
great
guy.
guy. He is now the CEO of a Bitcoin mining company that is eluding my memory right now. So apologies, Aaron. But he would always make the point that you made. Like, in no other sector do you see commodity producers hoarding the commodity that they produce. I think there are a number of reasons for that. I mean, those commodity like oil production, as you wouldn't well know, and gold mining, those are very razor thin margin businesses in a lot of regards. Maybe not oil. I know gold is.
Depends, dude. It's a lot like Bitcoin,
Yeah,
but
right,
they don't hold spot oil really.
right,
Yeah,
right,
financialize it. Yeah, they hedge their production costs in
right.
ideal world at least.
Yeah, for sure. And I think that one of the reasons why public Bitcoin miners have hoarded Bitcoin, I think there are two things here, maybe. These are kind of treated as hybrid commodity producers and high tech growth stocks. So they've always been able to sell equity to cover their costs. And in doing so, this feeds into the second point. They were able to build massive Bitcoin treasuries, like Marathon is a great example. They were able to build Bitcoin treasuries that basically made them even more attractive to the market because they were treated as these proxy Bitcoin plays, right? Like, when you're purchasing Mara, you're also purchasing shares for a company that manages a massive Bitcoin treasury, right? So, all of that being said, I think that when we look at this, we look at Mara and it's got $1.1 billion worth of Bitcoin. This was priced at the end of Q2, so it's a little less now. Bitcoin was at 63K at the time of this. But Mara is using that old model. They've always held their Bitcoin. They've always stacked. They've always trumpeted that. They just bought $250 million worth of Bitcoin by issuing a convertible note, I believe, recently. And then you have on the other side of that, you have the BitDeers of the world that hold very little Bitcoin. And it's almost like an old miner versus new miner dichotomy. But maybe that's a good transition to hop into Beezy's BitDeer report and show y'all some of the great research that he's been up to there.
Yeah, we love Brandon Bailey, newly just joined Amanda Fabiano with Second Gate Advisory. We're going to refer to him as Beezy here. Again, this is Beezy's opinion, not Block Space or the Mining Pods, but we do think he is a rock solid, top tier, um, uh, just mining analyst in general. So
Yep.
happy to feature some of his insights here.
Happy
And
to
this is,
feature his research. And on that note, we are open to op-ed submissions. That's not a guarantee that it will be published, but if you have something that you want to say and you think it's worth saying, please email me at colin@blockspace.media and we'll take a look. That's Colin with one L. You can also find me on Twitter at As I Lay Hodling. You can find me on Telegram with the same handle as well. But So, Charlie, if you could just scroll down to the takeaways here, and then I'm going to switch over to the actual report itself. So, Brandon is making the argument that BitDeer, relative to its peers, is significantly undervalued. And a large part of that has to do with not just its current megawatt capacity and its power pipeline, but also its ASIC manufacturing business that it is currently trying to stand up. And what Brandon argues in this article is that essentially, if we assume that the market is pricing these miners based on how many megawatts they are currently how many megawatts they are currently operating, and current and future megawatts, in addition to auxiliary business lines, BitDeer ought to be in the top 5, arguably maybe even in the top 4. And the power pipeline alone, as we showed in that one chart, kind of necessitates this repricing, because BitDeer has 1.2 gigawatts worth, 1,200 megawatts worth of power capacity that they are planning to put online by the end of 2025. That's more than they currently. That's doubling and then some what they currently operate, which is huge. And if they do end up standing that up, you're going to probably see a significant repricing. But perhaps the more interesting point that he makes, and I'm going to share my screen here, Charlie.
Yep.
That's not the right one. Damn it. We are out here.
We are out here
being complete boomers. Okay, here we go. Well, not you. You're always good with it. I think probably the most interesting piece of this, because Brandon goes through a lot of the metrics that we talked about just a few minutes ago, and a few others. Highly recommend going and checking out the report. You can either go to blockspace.media and find Beezy's tweet that has the report, or go to Beezy's Twitter account. That's at Bitcoin Beezy, and you can find a download to the report. Highly recommend reading it. Some great alpha in here. But the most interesting thing about BitDeer, as Beezy points out, is its burgeoning ASIC manufacturing business. Now, for those of you who don't know, and you probably do because our listeners are diehard Bitcoin mining fanatics, there are really only 2 kings in the ASIC manufacturing business. There is Bitmain and there's MicroBT. And then there's kind of Canaan. They're still around, but their machines aren't as competitive as Bitmain's or MicroBT's. But BitDeer was founded by none other than Jihan Wu, one of Bitmain's co-founders. And BitDeer is standing up its own ASIC miner manufacturing business. And this includes allocation. Oh, Charlie's breaking out.
I got
breaking out
two.
the miners.
I got the S9 and I got the What's miner. So the visual demonstration here. The duopoly.
The duopoly in the cold metal flesh in front of us, everyone. So BitDeer's trying to disrupt this duopoly. And if there's any company that is currently seeking to create ASICs, and there are a couple, or there are a few, the biggest ones that come to mind are BitDeer, Jack Dorsey's Block, and Auradine. If we're going to bet on one of those, BitDeer is probably the best bet. And that's not just because Jihan and the staff are of Bitmain, because there are staff in BitDeer that Jihan plucked from Bitmain. But it's also because they have TSMC tape out allocations. So TSMC is like the gold standard for these ASIC chips for the miners. And it's very difficult for a Bitcoin mining company to get allocation at TSMC. BitDeer has done so. Now it's just a question of how many machines can they reliably produce over the next however many years, right? It's I think the analogy I used in the spaces this morning is it's like what Elon Musk says about car manufacturing. The hard part is not actually designing the car. It's about getting the manufacturing processes in place to mass produce it. And I think that that's a similar problem that we've run into with ASIC manufacturing. You can get the chips, but are you going to be able to scale appropriately to actually be competitive at all? And that's kind of the biggest question mark for BitDeer going forward with this. These are the advertised specs for the Seal miner. Just a point of clarity, the ASIC efficiency is specifically referring to the chip. The machine efficiency is once you have all of the parts together, the fan, the chassis, all that kind of stuff. What is your joule per terahash rating?
We
And
should
if we
break
look,
that down sometime. Maybe not here, but we should really like differentiate, because I think this is an important thing when we talk
yeah,
about like ASIC efficiency.
yeah, and a lot of the ASIC manufacturers that are trying to get into the game will do the chip efficiency, which is somewhat misleading. I mean, it's not wrong, but it's not the full picture, right? It's like saying, well, my car gets 20 miles to the gallon, but once you strap a trailer on it, it gets 15, right? And so, but if we look at the machine efficiency for the Seal 2, which is the Seal 1 was their, I think their first crack at things. Seems like the Seal 2 is going to be, the Seal 1 seems to be more R&D. The Seal 2 is the one that they're going to try to mass roll out in Q4 of 2024. And its machine efficiency is competitive if these numbers are accurate. That's the biggest question with the current next gen machines that we see from Bitmain and MicroBT. It will be very, very interesting to see if BitDeer can pull this off. And if they do, as Beezy points out, this is basically vertical integration for them on steroids, because no other public
The
miner,
holy grail.
it is the holy grail. It is the milkshake. It is everything. If they can pull this off, they will be able to produce and procure hash rate at a deep discount to spot compared to if they were going to go to Bitmain or MicroBT to purchase that hash rate. And if that does happen, then as Beezy points out, we should see a significant repricing for BitDeer. And this is not even to account for the fact if BitDeer pulls off this ASIC manufacturing business, and if they even get to, a fraction of Bitmain's size, the ASIC manufacturing business alone might be worth more than what the business is currently valued at. So, all of that to say, again, not an endorsement, not telling you to go buy BitDeer. This is not financial advice, but BitDeer may be one of the most interesting public miners on the scene right now just because of this ASIC business alone. So, that's kind of the TLDR. I think that covers most of the meat in this report.
Yeah, a lot of people think, well, I want to get into the picks and shovels of Bitcoin. They say, oh, Bitcoin mining, you manufacture the Bitcoin. But no, no, no. The picks and shovels are in the actual ASIC game. So that's where the real business is now. We'll see. I mean, man, I just love this because, last cycle, these Bitcoin miners were pretty indiscretionarily traded. Like, Bitcoin goes up, they go up. Bitcoin goes down, they go down. No difference. But now, um, we have highly differentiated companies, highly differentiated strategies, depending on your macro outlook or what you think. Like, what do you think the state of macro looks like? What do you think the price of Bitcoin looks like? What do you think hash rate looks like? Well, are you worried about Taiwan Semiconductor ever maybe haltering because of some geopolitical tensions? Like, these are now things you can bet on with specific equities positions. So I like that, although I don't take a super active role in that. My killer edge is more on the JPEG side, but
very,
but yeah.
very distinguished, uh, very distinguished career path. I'm sure you love talking to your in-laws about what you are currently doing. I say
Yeah,
that tongue in cheek.
I got a real job, I promise.
I feel like that every time I talk to my father-in-law. It's like, no, I swear this Bitcoin thing is real. The ETFs kind of changed that for him, though.
Yeah.
Once he saw the ETFs, it's like, oh, it's legitimate now. It's like, yeah. I mean, that's what the ETFs are. The ETFs are boomer fuel. Like it's like a stamp of boomer approval. Bitcoin can now enter the realm of real assets because it's on a ledger somewhere at a bank, and that's a great thing for them.
Hey, yeah, they could log into their Chase Chevy account or whatever they use and go in. I'm gonna do that. Their Chevy Chase account. Buy BTC, and it's right there. Well, or even better, they call somebody with a telephone to tell them to go buy it for them.
Yeah, or
Yep,
fax it,
exactly.
fax a buy order.
Oh yeah.
Send a Western Union telegram.
Still faster than trying to build an AMM on Bitcoin, which is a whole nother topic. So
I'll have to tackle that someday.
yeah.
I want to close with, is AI a meme? It almost certainly is a meme to some extent, just like everything is a meme. Narratives matter more than truth. We are in a post-truth world where only vibes matter. And right now, the market is saying that the AI vibes are good. The browser can't access your screen. Well, hang on.
The
No,
AI vibes are good. It's I mean, it's a meme until it isn't, because it's pretty clear that Bitcoin miners have the power capacity and the power contracts, and that is a very material play. Do you want to bet on the actual revenue from the HPC itself? I have no idea. I feel that a lot of the people, the so-called experts who are analyzing this, shout out to the experts, love you guys, but frankly, like, you've been in this game for like 6 months, maybe 12 months, okay? Like,
I think that's a really good point. No one really has any idea how this is going to pan out, and I think that we've talked about this before. And I'm sorry, everyone. I'm really trying to share this, but my computer's for some reason it's giving me the
send me the
pinwheel.
link on a different platform then
The
also.
problem is it's a report, so I need to just share my screen. But I'm gonna try to do that in a second once I stop getting this pinwheel of death spinning in my face. That's a really good point, and something that we need to have a show on hopefully soon. And if anyone's listening to this and they actually have expertise in this, please hit us up, because it's probably the most fascinating thread to pluck with all of this. Um, Bitcoin mining markets more or less converge on one spot price via hash price. It's very similar to other commodities market, where there's really not much difference between any spreads regionally on a commodity in one area versus the other. It's all kind of converges on one price. We call that hash price, right? FPPS pools kind of set that floor for what hash price is. You either sell your hash rate to a pool or you sell it to the Bitcoin network directly. But if we were talking about AI and we're talking about HPC, there are so many different variables at play for what type of compute you're producing, what it can be used for. There's probably latency issues in terms of geography. I don't know how these markets function in terms of how do you price 1 megawatt of HPC compute versus another one, right? For Bitcoin mining, the pricing is basically standardized, but it's not, I would assume, for a lot of these other compute commodities through HPC and AI. So that's going to be a big, I think, not just for Bitcoin miners, but for the compute equities landscape in general. It's going to be a big question for people to answer: is what are we actually purchasing here? What are you actually selling? How valuable is this compute? And I don't have any answers to that question. And I also can't seem to pull up this chart. But basically, what it is, and I'll link it maybe to the show after we're done. If you look at year to date, and this was year to date in mid-July, so this is a bit outdated, but if you looked at year to date returns for miners with an HPC and AI strategy versus miners without, the HPC and AI miners have been outperforming the pure play miners basically all year. The flip really happened. Well, not basically all year, kind of like halfway through the year. There's this flip that happens at the beginning of June, where the HPC and AI strategy miners start going up and the other miners kind of start plateauing. And all of that to say, I think that this hype is going to wear off eventually. And these miners are going to have to answer for whether or not they actually have sustainable strategies. And that's going to be, again, one of the bigger threads to pluck over the next year or two. Which ones can actually make the transition? Because some of them, like Corsair, are going all in on it. They don't even call themselves a Bitcoin miner anymore. They're basically an AI high performance compute play.
So with that, let us know, AI, is it a meme? Is it not a meme? If you have particular insight to this, we actually welcome some audience participation. So hit us up, hit Colin up in particular. And otherwise, I think that's we'll move to the call to action here. Make sure to subscribe to all Blockspace content, sub to the Mining Pod YouTube channel, to Bitcoin Season 2 YouTube, Gwart Show. Make sure to like and subscribe, hit the notification bell, and make sure to get the newsletter on blockspace.media. You can get the newsletter, get a lot of these types of insights from Colin and Blockspace and friends. So otherwise, any other last words, Colin?
Nope. That's it, man. Beautifully done. Don't take out a HELOC on your house to buy Bitcoin mining stocks. That's all I have to say. Or monkey JPEGs.
Both of those things are bad ideas. Those are fun pastimes. See you all next week.
This is y'all.